Hey, it's Tom here, and welcome back to another episode of the Investing with Tom podcast. I really appreciate the support on this new YouTube channel, focus on the podcast so far. It's been very encouraging to kind of see all the positive comments and likes on the videos and so on. So if you do enjoy this episode as well, definitely be sure to subscribe to the Investing with Tom podcast channel and give it a thumbs up if you enjoy this type of content as well. Now, in this episode of the podcast, we actually have a returning guest, and that is Jason Rothman, aka the After Dinner Investor. If you're a fan of the Punch Card Investing YouTube channel where we do our weekly live streams, you may know Jason as the king of the chat. He is a returning guest and sort of a crowd favorite on both Punch Card Investing and here on the Investing with Tom podcast as well. So it's always good to speak with Jason. In this particular episode, we covered a few of his more recent investments, in particular those in Alibaba, and Prosus / Naspers / Tencent. And we also covered his kind of mental model of cloning. He is a big fan of Monish Prabrai, the shameless cloner himself. And Jason describes himself not as a shameless cloner, but as an intense and ferocious cloner. So with all that said, let's get straight into the episode. If you do want to see any more content from Jason specifically, all of his links will be down in the description below. He has both a podcast and a YouTube channel as well. So be sure to check that out. But without further ado, let's roll the episode, and I hope you enjoy.
The After Dinner Investor is in the house. What's happening, Jason?
Tom, thank you very much for inviting me back on your show. It's great to be here. Quick question for you. Is my episode the one right after William Green's?
I'll tell you that offline. That's top secret information. I can't give away the rankings because you make other guests feel bad,
Okay.
you know. But we did break a world record last time though, and that world record.
Oh no,
still
not
stands.
rankings, Tom. I mean, am I showing up after him? Like, am I supposed to follow him up? Because that's a lot of pressure.
Oh, I'm with you now. You are following up William Green, so yeah, no pressure. But
Wow.
those are big shoes to fill. That's a big guest to follow.
Yeah,
up.
quite big shoes. Yeah, so I guess thank you for that, Tom. But I was wondering that today when I was preparing for the show. I was like, am I really going to have to go after that interview? But here I am, everybody. So it's good to be here. And yeah, Tom, that was a great interview. And thanks for putting that together because I just finished up reading the book and it was great to hear you interview him as well.
Yeah, appreciate that. He was good to talk to. But before we go any further, before we get into the episode, I know we're recording this a little earlier in the day for you than you usually record your podcast. So I can't ask you what you had for dinner, but you got to tell us what you had for lunch.
Had a bowl of baked potato soup. I heard that's those carbs, they lead to high energy and they lead to productivity. So that's what I had right before we got on, and you got to see me finish it up. So Tom, was it everything you dreamed of, watching the After Dinner Investor kind of consume a meal in front of you?
Yeah, that's like After Dinner Investor OnlyFans content. I think you're getting a bit of a preview of that. Not many people have seen it.
Yeah, not many people have seen it. High value content. Yeah, just finished up a bowl of baked potato soup, and tonight we're having some ribeye steaks. So it's going to be a good dinner.
Yeah, very nice. And I know you're on a bit of a time crunch here for this episode, so we better get into it. I know you always like to start your podcast off, for anyone that hasn't tuned into the After Dinner Investor podcast before, with a super investor sip. So I may just hand it over to you to talk us through that and remember the three things that Ben Graham taught us before we get into this thing.
Okay, Tom. Well, happy to do it for your audience. Everyone grab your favorite drink. Mine is coffee. And let's become super investors by remembering the three things that Ben Graham taught us. Number one, a stock is not just a piece of paper, it's ownership in a real business. Number two, Mr. Market is there to serve us and provide us with opportunities, not to guide us. And then number three, the most important one, I think, always invest with the margin of safety. So with that said, let's become super investors by taking our super investor sip.
What do you got there, Jason? Coffee?
Tom, can you, I got a coffee and some water. Can you attest to the fact that the super investor sip is real? Have you felt like it's helped you?
Yeah, I listen to your podcast pretty religiously, and I always participate in the Super Investor Sip, and the returns are going okay. So I can vouch for the Super Investor Sip for sure.
Well, good. That's where they come from, Super Investor Sip.
Absolutely. All right, Jason, let's get straight into this. We were talking kind of in the last couple of weeks around what sort of topics we should cover here, because I know you're deep in the weeds, kind of, trying to understand real businesses and remember those things that Ben Graham taught us. And we've got kind of a handful of topics, largely around some individual companies you've been looking at recently that I'm keen to talk about. And then I want to spend a bit of time talking about cloning, because you are maybe second to Monish Prabrai in the shameless cloning ranks. Maybe you're trying to take him on for that top spot. I'm not too sure, but I'm keen to chat with you about that as well. But I think a good place to start this discussion off is with a couple of your more recent stock investments. So I know we recorded an episode for your podcast around Alibaba. It's been a very hot topic recently in the value investing world. And the price just keeps going down. We've seen Charlie Munger take kind of a second bite at the apple with Alibaba. So where are you at kind of with that position right now, and what kind of things are going through your head?
Well, I feel really good about it. In terms of kind of where I'm at, I like the investment for the same reasons that we talked about. Of course, I got a boost of confidence when we saw Charlie almost double his shares in the third quarter. Nice thing when we saw that 13F came out, the price of Alibaba, it's gone up in the past couple of weeks since that 13F came out. But that day, it was lower than at any point during the third quarter when he was doubling his stake. So that was like a big boost of confidence. And then we'll see what happens with our other super investors with their 13Fs on November 15th, what they did in the third quarter. It will be another boost of confidence if they buy and at least don't sell. And so I have the super investor aspect still going. In terms of my outlook on the company, I'm planning on holding that business forever. And when I say forever, I literally mean forever. Like I picture being 90 years old and still having my stake in that company. Of course, we have the wonderful business checklist. Is the business continuing to get better, and is it egregiously overvalued? And if it's getting better and it's not egregiously overvalued, it's very easy. You just hold. And so that's what I plan on doing. I did buy a little bit more recently as the price just has kept dropping. So that was a good opportunity. So everything's basically the same. The only difference is that I have now taken out Ant Financial from my calculation in the company. I'm kind of writing it off. The regulations that have come in, they are changing the company. It's probably maybe in the short term making the company less valuable. I think you could argue maybe in the long term, the closer they are with regulators for a business like that, maybe it's more valuable in the long term. But that's kind of my thinking on Ant. There's a lot of changes there. I'm writing it off. If we still get our third stake in Ant and it's still worth a ton of money, that's awesome. And if we don't, and if it's not worth as much or a lot at all in the long run, that's okay. I still like Alibaba for all the other reasons in terms of the cash flow yield, the opportunity to buy a wonderful business at a fair to really good price, the prospects for cloud. I think some people are really, really positive on what that could become once that market develops, and then their net cash, and then just the awesome e-commerce businesses they have, and the long runway in terms of the growth of internet commerce and the growth of China's middle class. So only thing that's changed is writing off Ant Financial, and that'll just be a cherry on top if we get it. So that's where I'm at. What about you?
Yeah, I think I'm in a similar position. I mean, when I was doing my initial valuation work, I think we spoke about this on your podcast, but I almost had already not maybe written off Ant Financial, but I'd kind of put it in the too hard basket from a valuation perspective. So my focus had always been really just on the e-commerce business, and then I was sort of saying, we get cloud, which is only just reaching profitability, and then we also get the 1/3 Ant Group stake kind of on top of that. So yeah, I mean, some negative things have kind of been happening with Ant, and I think it makes it even harder to value. And yeah, it'll be kind of an interesting one to see how it plays out. But the core of the thesis was e-commerce and cloud, I would say. It does get compared to, it does kind of get called like the Amazon of China all the time, which we've spoken about before. I don't entirely really agree with that sentiment. They have quite a different business model to Amazon. But one of the things that did allow something like Amazon to really take off is the growth in Amazon Web Services. So if we can see something similar with, Alibaba Cloud over in China or Asia more generally, then I think that could be a really nice tailwind, even sort of e-commerce and so on the side.
Yeah, and I'm definitely, I feel like I have an advantage, and any long-term shareholder in this company has an advantage, because right now the news around China is obviously not great when it comes to the business news and regulations and all that. And then you hear what major investors in the US and institutional investors, the way they talk about China right now. And there's obviously a lot of uncertainty in the short term. But if you don't think those businesses are going away, or the right to own those businesses is going away, and you could picture holding them for 10 or 20 or even longer, 30 years, then in my mind, you just kind of sit through the uncertainty right now. You sit through the volatility. You understand what you've invested, the amount you've invested on paper, it has gone down and could continue to go down. And my mindset is I'm just doing the wonderful business holding checklist. And the other thing I'm looking at is, okay, if it just continues to drop, maybe there's another chance to buy. But I've kind of put my own odds on the situation, and I think it's like a 90% chance everything kind of works out okay for shareholders around the world for Alibaba. And it's still a business that you're allowed to invest in, that you can invest in, and that they get through their current regulatory issues and come out on the other side, still a very, very strong business. I look at those odds as 90%. And then I look at the downside as like, okay, maybe some really bad stuff will happen, or maybe I'll lose a lot of this investment, maybe more. I look at those odds as maybe like 10%. And so the way I'm looking at it is, if I can get like a 90% chance of getting a wonderful business at a decent price, maybe even a cheap price with a long runway, I'm going to do it. And I think I've made like a 12% bet in the after dinner investor portfolio. And I think personally, it's probably around there, maybe a little lower, like 10%. And I'm just content to watch the story play out and to, for the most part, hold and maybe buy a little bit more as it continues to drop. But that's kind of where I'm at. And it'll be really interesting to see where things are kind of 5 years from now. So I'll check in with you in 5 years and let you know how it's going. That's kind of my mindset as an Alibaba owner.
Yeah. Yeah, it's really interesting. I think I put this on Twitter a few weeks ago, but the place I've kind of arrived at with Alibaba is that if you believe that, foreign investors are still going to be allowed to own Alibaba long-term through the VIE structure, and then Alibaba doesn't have to sort of pledge or donate or whatever you want to call it, all their free cash flow, ad infinitum. I think those are probably the two main things you really have to get your head around. I think if you can get across those, which I don't know if they're easy questions to answer, but I think if you can get across those, the valuation, it's hard for the valuation not to make sense at these kinds of prices.
Yeah, it's a different system with different players, different dynamics. And I think if you understand that, at least for me, I feel comfortable with, a portion of my portfolio in that system. Wouldn't feel comfortable with going into a third in Alibaba or more, something like that. But where I'm at now, 10 to 12%, maybe 15%, like I'm wanting to let this story play out. And again, odds 90-10, in my opinion, I think it's gonna play out good. So, and it's just interesting. We're so worried about regulations and the odds of political dynamics playing it out and all that kind of stuff. It sounds like everybody that talks about Alibaba is pretty strong or pretty bullish on the actual business itself, which of course we've been told to focus on the business itself. And man, that business looks like it's in a good spot, and it's got a long runway, especially for the way it's priced.
Mm-hmm. Yeah, I like it. Would you treat those sort of portfolio allocations any differently if this was an American company? Is that a thought exercise you've gone through yet?
Yeah. So what if Amazon was trading at a PE of 15 or something like that? I think it's a fair price. And it's not really fair comparison because say it's a 15 PE, but then say a smaller percentage of America's population was online and we had a much larger runway. Like I'd probably be willing to put more in for sure. I don't know if that gets near 20% or more. I think part of it has to do with what else is available. But so I don't know the exact number, how high I would go with my allocation, but I can tell you with certainty that political situation and the reasons why a lot of investors don't want to invest in Alibaba right now, that does hold me back allocation wise. Because where I'm at with allocation lately is like the more certainty I have about a situation, the more confidence I feel in my knowledge of a situation, the bigger I'm willing to go on allocation. The less sure I feel about my footing and kind of where I stand, the lower I go with my allocation. And so, yeah, if it was in America, and obviously I know this political system a lot better, I'd for sure be up in my allocation. And so I guess for me, that whole situation impacts my allocation decision. And then I think it seems like most of Mr. Market or the institutional investors, that situation not only it influences their allocation in the sense like they just don't even want to be involved with it right now. They want to let it kind of play out and get back in when they feel more confident in the situation.
Mm-hmm. Yeah, I have pretty similar thoughts. I think when I spoke to you last, I had maybe 12 to 15% of the portfolio in Alibaba. I've actually moved that up a little bit recently. I'm probably closer to 20% these days. I've kind of averaged
in terms of
a little bit as the prices come down.
Okay, gotcha. As it's come down,
yeah.
That's a big bet for Tom. That's a big bet. I don't get the sense that you're often a 20% guy like some other YouTubers.
Yeah. Well, I think you'd be surprised actually. I mean, I don't have a huge number of holdings, so that's not my biggest allocation.
Wow. Okay. Well, good to know. Are you willing to say what your biggest allocation is?
Yes, Cerritos.
Cerritos. Wow. Okay.
Mm-hmm. Yeah, Cerritos Growth Properties. I think that's one I actually bet quite small on initially. I think that was, well, by my standards at least, I think it was maybe a 7 or 8% position. When I was first kind of working through that, and when Brad did all that great work kind of on valuation and so on. And as I've kind of just understood it more and got a better feel for what the redevelopment sort of costs and timeline, might look like, I've just become more comfortable with the situation. So I don't know if it's even the type of scenario where, I think it could have the highest upside. Of just kind of become a little more confident that there's a lot of downside protection. So I'm willing to allocate a little bit more to something like Cerritos.
Now, is it fair to say they would have gone bankrupt and our holdings would be zero if you were holding in March of 2020 when the coronavirus hit, or maybe it was then? I just know at some point I remember hearing that their lender, Berkshire Hathaway, was a friendly lender and allowed the party to go on. So would it be fair to say if they had another lender at that point, there would have been a possibility that they could have gone out of business?
Yeah, I think that was a possibility. So I wasn't in Cerritos at that time. I was sort of post Monish Kabrai getting into it. And then I guess the future was slightly more certain from a pandemic perspective. But I think that's a fair take. Yeah, I mean, Berkshire have been more lenient with their, they've been more lenient than other lenders might have been, I think. But at the same time, we've heard Andrea Olshan, the new CEO of Cerritos, talk about how, Berkshire's a nice sort of a nice lender to have because they're not the first people to drag you through bankruptcy court, but it's also quite expensive debt. I think they're paying something like 7% interest on that debt, which for commercial real estate is getting up there.
That's that Cerritos stock and business. I got in there at I think $15 a share. Or actually maybe like maybe like 14 is my average cost right now. I think I'm up like 10% or so as it sits at $15 today, and it's kind of in the last few months come back down to $15, and it's definitely been catching my attention because I am like I did make like a 7% bet or 7.5% bet, something like that. Still have it. I totally get the upside in the sense that, like, if I'm understanding a lot of people's analysis and the work that you and well, I should say mostly Brad, right? Like, you press record.
Mostly Brad.
No, I'm kidding. I'm kidding, Tom. We just we do owe Brad for that one. You know, he was in the trenches there, looking up all the comps. So I mean, the work that both of you guys did, and that Brad did to a large extent. If I get it, people are kind of thinking like the floor in terms of what they own, in terms of their real estate assets, is like $30-something a share, or the net asset value after the debt. And that's kind of the way everyone's looking at the margin of safety. And then what is the upside? Well, the upside is just unknown in terms of like how hot the real estate market is in the future, how well they develop those kind of crown jewel properties that they're focusing on, and then what the market kind of decides to value it. So in my mind, it's harder to talk about upside and even know like where it would go, but it's definitely seems like not everyone, but it seems like there's people are looking at it that it's safe in the sense that there's like a $30-something a share amount of net assets there. Is that how you get the sense people are looking at it?
Yeah, that's certainly how I'm looking at it from a downside perspective. So the real risk in my mind for Cerritos is, I think if it does go, if this investment doesn't work out, I don't think it's the type of investment that kind of goes to zero overnight, because they've got a lot of net asset value sitting there, unless something crazy happens on the debt front and Berkshire does kind of change how they're looking at Cerritos, which I don't think is that likely personally. I think the risk is that they have their redevelopment projects just take a lot longer than expected, and they have a negative cash burn for a really long time. And they can make more cash. They can make more cash available from selling properties. But yeah, I guess the longer that portfolio is kind of bleeding cash, the more you have to kind of self-liquidate to keep funding yourself, and it's kind of a melting ice cube in that way. So that's the real risk I see from Cerritos.
So since there is debt at any given moment, if we go through 2008, 2009, or the credit markets freeze up, or the real estate markets freeze up, and just no one's doing business, and we have a once-in-a-generation scare, crash, recession, depression, whatever, because there's debt on those books, we probably have a problem. My point is, every day that goes by, we are running that risk that kind of macro environment could happen. But I guess the bullish look is that the risk of that is low. We do have a lot of assets compared to the debt. And then I guess someone, I think on Punch Card the other day or a couple of weeks ago, made like a good point. Like, someone was saying, well, over time it's become more risky as we're still waiting for them to develop these assets and kind of show us that this story is going to work out. And then someone else said, might have been you, but someone else said, well, actually, I think as time goes on, it gets less risky as real estate asset values recover and rise, if that's happening. So I thought that was an interesting perspective as well. Let me ask you though, where I'm at is a 7.5% bet. I totally see that floor, like in terms of what the assets they have and the net asset value. And it does seem to be like a lot more than $15 a share. But in my mind, like when Monish got it during the peak of the crisis, March, or that first quarter or second quarter, and it's trading at 2020, it's trading at like $8, $9 a share. That to me seems like really, really nice margin of safety. Where we are now, I don't get enthused to go from like I want to go from a 7.5% bet and then see this opportunity and go, wow, this thing's margin of safety is double what it is currently, the net asset value. So I want to go to a 10% bet, a 15% bet, 20% bet, and really cash in on this thing. I want to get there, but I'm not there because A, the debt, and then B, I don't feel confident in my footing of where I'm at in terms of understanding their story and understanding just how much closer we're going to be to the promised land a year from now, or what I should be watching. So, and I know I can do more work on that company. So my question to you is, do you think that's a fair place to be? Like, you understand how average intelligence investor could kind of be in a spot where they're like, yeah, I kind of get that there's value there. I just don't feel sure on my footing, and I don't know if I'm going to be able to get there. Do you think that's a fair take, or do you think that's just lazy? And if I just dive in and do more work, the answers are in front of me. Like, which one's more accurate to you?
Yeah, I'm probably somewhere in the middle, I would say. I don't think it's, I think it would be tough to get all the way there and have complete certainty on, when cash flows exactly are going to turn up, because there's a lot of properties in the portfolio that are going through pretty extensive redevelopments. But I think you can get reasonably close. I think it's with the Dallas development off the top of my head. I might have to pull this up, but there's various sort of sites on the property developers floating around that you can go to, and it sort of lays out all the different phases that they have planned around when, this part of that development's going to open up, and then this part of the development's going to open up. So that gives you a bit of clarity on timelines. And there's another guy who, I don't know if you have come across him or not, a guy by the name of Matt Peterson. Have you come across Matt Peterson before?
I've seen him show up like in the YouTube suggestions, and then I've also heard you and Brad and the Punch Card guys kind of talk about his stuff he has out there on the company.
Yeah, so he did a pretty similar exercise to what Brad did in terms of going through, property by property. Sorry to Brad, but I think Matt Peterson kind of did a little bit more work on not just necessarily getting comps, but actually understanding like what those properties are doing and how much is just empty space versus buildings and all that stuff. So he was getting quite detailed with sort of analyzing the portfolio. And he's actually one that I've seen do quite a bit of work on understanding the costs, like what's the cash outlay required to actually get these properties to where they need to be. So in his annual meeting recently, which is on YouTube, he sort of went through all the he sort of broke the property portfolio out into a few different segments and sort of valued each quite conservatively, like using very conservative cap rates, and then also had like a conservative view, in other words, like overstating what he thought it might be for what the capital expenditures are going to be, and then kind of looking at, what sort of net asset value and cash flows are we looking at kind of 4 or 5 years out. So, that'd be an attractive situation. Yeah, he was
as he lays it out, it's attractive.
As he lays it out, it's attractive. He was getting to, as conservatively, very conservatively, like he's using sort of 8% cap rates on some of these properties where maybe something like 6 is more appropriate, which is quite a big delta when you look at that on sort of a net asset value basis. He was getting to, and then you've also got leverage in the situation because of the Berkshire debt and so on. But even with those assumptions, he was getting to, I think, about $35 a share, kind of 3 or 4 years out. Which is, more than a double from today's prices. And again, it could be higher if those assumptions prove to be conservative.
I hate that debt. I always hate the debt. It's like the situation seems so nice and undervalued, and it seems so easy. Like, okay, just develop these properties, sell a bunch of them to develop the crown jewels, and then we'll have an awesome business with tons of cash flow and all that, and it'll get priced a lot higher than it is now. The problem is always just, how do we, make it through that debt? But I guess that's probably why it's priced where it is, why there's opportunity.
Yeah, I mean, it's a double-edged sword, right? There's obviously big downside with leverage if you run into trouble, but it can create a lot of upside as well. The other thing that's I'd have to check the exact numbers, but I believe Cerritos doesn't have any big debt payments coming up until 2023, so they've still got a couple of years to kind of position themselves properly for that. And then because they have so much debt and they're paying like 7% interest or something on it, if they can refinance that at lower rates, that moves the needle quite a lot in terms of Cerritos cash flows as well. So you could almost look at it as an opportunity from that perspective.
Yeah, definitely. Definitely.
Mm. But yeah,
Well, it's
we'll have to wait
interesting
and
to
see
know
how
that
that plays out.
that's your biggest holding.
Mm.
Yeah, it's
Yeah, it's
interesting to know that that's your big one.
yeah, it's one I've sort of slowly added to over time. I must say I've been fairly short on ideas these last couple of years, but you only need one or two a year, right? So I've kind of just been steadily adding to some of the others where I feel more confident.
Tom, are you in Prosus or Naspers or Tencent?
I'm not, but we should talk about it. Maybe you can convince me what's going on there.
Okay, well, I did. I call it a lazy analysis, and I've looked into this. So basically, the genesis of this one is Monish. He's on a little bit of a break right now on the YouTube lectures, and he deserves it because maybe it's his off season for the YouTube lectures. Because for the first part of 2021, I mean, it was just raining gold every day. Like there were so many videos that he put out, and so many lectures and Q&As. And in one of them, they got to talking about Tencent and Prosus and Naspers kind of adjacent to the Alibaba talk. And that's the first time I heard about these about Prosus and Naspers. And then it's the first time I really had ever been interested in Tencent. So I heard him talk about it, and then Brad started talking about it, and then it gets talked about on Punch Card some. And initially, I was like, all right, well, I'm in Alibaba. I read the book on Alibaba, The House That Jack Ma Built, did the work on that. That's enough. I feel comfortable with that. But then, and then also like Tencent is more video games and social media and all that. And that's not really my wheelhouse. So I just wasn't attracted to it like I was with Alibaba. But then at some point, something just grabbed me, and I was like, maybe I should look at this as well. And so I guess the story is that you have Tencent. The price is down, just like Alibaba is down. I don't think it's down to quite that extent, but it's down, just like everything's down over there. And you have this, what looks to be a wonderful business. They have this business called WeChat. And just like with everything in China, it's never going to firmly be in my circle of competence because I don't use their social media. I don't use the internet the way they use the internet and all that kind of stuff. I'm just in a different country, different culture and all that. So not going to be in my circle of competence fully, but my sense of it is that WeChat is some kind of super app, and it's kind of almost a portal or a gateway to the internet experience, or experiencing a large part of the internet in China. That's your WeChat. And then through WeChat, you can do payments, you can send money to friends, pay bills. There's social media, you can do meetings and chats and all that, and work. There's and like they have like 1.2 billion users or something like that. Like it's just it seems to be a very, very strong business. Yeah. I think it's WePay they have inside of WeChat or something like that. That's their payment app, I think. And then they have this huge video game business. And then they have this huge venture capital portfolio of listed and non-listed companies, I think, around the world. And then they have the potential of like having a big cloud business one day. That's my kind of view of Tencent. And when I looked at how much it cost, I just kind of, before I looked at the price, I was like, all right, well, what if I, and by the way, everything seems to be growing, revenue, free cash flow, profit, all that kind of stuff seems to be growing just like Alibaba, long runway, that kind of stuff. And I was like, well, what should I pay for this? And I kind of thought like, well, I could put money in a bank account and that's paying me 0.5% of interest. And that's safe money and all that, at least from volatility. So how do I compare that to what I could pay for Tencent? And I was like, well, I literally have no idea what a fair multiple is. Free cash flow for a wonderful business. I don't know. I guess it's whatever the market says it is at any time. But my thinking was like, let's just pick a number out of the hat and go 20. And I was like, what if I said their free cash flow was worth 20 times the free cash flow? That's a 5% yield. That's 10 times what I'm getting in a bank account, and I'm getting it on a wonderful business. So let me value their cash flow at that, their free cash flow. Okay, that comes out to a certain number. Let me add what they're saying their value of their venture capital portfolio is. Both, I'm pretty sure listed companies and non-listed companies, they say it's worth this amount. let me take away net debt of like 3 billion, I think, something like that, just a little bit of debt. Let me take that away and let me give absolutely zero value to being one of the bigger cloud companies in a country where a lot of people think their cloud business is going to grow a lot over time. Let me give zero value to just what that's worth. And the number I came up with was like fairly close, I'm pretty sure, to where it's selling right now. And so you're getting like a 5% or something like that. You're getting a little bit of a yield on your free cash flow. So you get some money back when you buy it each year. You're getting the upside of cloud. You're getting a wonderful business. You're getting the growth of China, and you're getting their venture capital portfolio. And so that's my thinking on Tencent. And it looks, to me, it looks attractive just because the price has dropped. But I honestly don't know if I would buy it without Naspers and Prosus, but I might be tempted. It's just that I feel a lot more comfortable, and like I understand Alibaba, and it also feels like Alibaba might be a little bit cheaper. And then I like the fact that Alibaba has net cash. So I don't know if I'd buy it just alone. But here's the thing. As I understand it, and these are kind of broad strokes, but as I understand it, there's a South African media company called Naspers. And in the early 2000s or late 90s, 2 decades ago, they invested like 30-something million into Tencent. And I don't know if it was like 30% of the company or just under 50% or something, but it was a big chunk of the company they bought for $30 million. They held and they held and they held. And they held that stake even as it became not just like most of their value, but like the vast, vast majority of all their value, because it was so much bigger than everything else. And they just held it, which was like one of the greatest investing feats and performances of all time. And then this company is sitting there as of a couple of years ago in South Africa. They're having problems with the South African stock exchange, where like there's issues with like tax issues, I think, and then like forced selling, and there's just issues to having that much value compared to everything else. And Naspers had always sold at a discount. That's the company I'm talking about. Naspers had always sold at a discount to their Tencent stake, like a big discount, because of these holding problems. And so what they did in the last couple of years, as I understand it, they transferred these international tech assets they transferred them from Naspers in South Africa to a company called Prosus on the Amsterdam exchange in Europe. And then Prosus owns what was a 31% Tencent stake. Now it's 29%, I think. Prosus owns that. And then Naspers owns like 40.9% of Prosus. And so where we are today is Tencent, wonderful business, might be on sale. Prosus owns 29% of Tencent. It's in Amsterdam. Naspers owns 40.9% of Prosus. It's in South Africa. We'll talk about the discounts that Prosus is selling for and Naspers is selling for and other stuff they do. Sorry to go on, Tom, but I'm trying to just get a feel for this myself. I've been doing a lot of work on it actually today before we sat down. Am I making sense so far?
Yeah. So I guess you've identified a great business, or what you think is a great business, 5% free cash flow yield, something like that. And then you've effectively found a way to juice that to 10% free cash flow or something if you can buy it effectively for half price through one of these other vehicles like a Prosus or Naspers. Is that kind of where you're getting to?
That's basically it. And the question is, okay, well, if I wasn't totally enthused to go buy it, either in the I don't know. I think it might have a ADR in the United States, but I would be going out and buying Tencent on the Hong Kong exchange. Do I want to go do that directly? Not totally enthused to do it. I might look at it, but do I want to buy it through Naspers? I think or Naspers or Prosus. Like my answer was yes, like a definite yes. And what happened was a week ago, I put out a YouTube or a podcast talking about kind of what I just talked about, and there's a discount, and there's kind of conflicting reports online on how many shares there are outstanding of Prosus. And some people listening would go, well, how can you not know how many shares are outstanding? It's very easy. It's investor 101 stuff. I was was going to make a joke, but I'll leave it there. But that's what I do these days, Tom. I leave it there. So I'm going to leave it there. But between like currency translations and different exchanges, and then Naspers and Prosus have done some kind of like share swap deal that I have no idea what's going on with that. I just cannot figure that out for the life of me. So there's a lot going on there. And if I went with the more conservative share count, meaning the higher share count, basically you're getting the Tencent stake in that Prosus owns, plus their portfolio of companies. Some of them are listed, some of them are not listed. And you're getting it for like an 18% discount, their net asset value, 18% discount.
Okay.
And as of a week ago, I was like, you know what? I can't figure out the share count thing. Let me just go with the more conservative one. And you know what? If it's an 18% discount on effectively this 10-cent stake, and then you get this other stuff they're doing in their company, they've got a lot going on in Brazil and India and a lot of like internet business kind of growth stuff. You know what? And we get that. Like, I'm happy to buy that, put my money in it at like an 18% discount. And that's pretty cool. And I ended up putting half of the stake in Naspers as well, because as I understand it, the discount's even larger. And I was like, you know what? I don't think I'm going to be able to figure this out fully. Let me just go with the 7% bet. That's what I did. Just about a 6 to 7% bet split between the two companies. Maybe it's an 18% discount for Prosus. Maybe it's a little more for Naspers. Seems to be some value there. I don't have to figure it out completely. Let me just park the money there. Wonderful business. Hold it. And that's the plan. That was a week ago. And then I got an email from a listener. And then I asked Frank on a punch card last night. And basically, the listener told me that, no, if you look at their investor relations page, Prosus, and you look at what they're telling you, how many shares they have outstanding, it's like, I think it's like 1.4 something billion, I think. And then like the more conservative view is like 2 billion or something where I was looking at online. And so if you take the share count from 2 billion to 1.4 something billion, 1.45 or something, the discount on their net asset value goes from 82%, like the discount is 18% and you're buying $1 for 82 cents.
Mm-hmm.
It goes from that to a discount of 40% and you're buying $1 for 60 cents. And, do the work yourself, check the numbers yourself. But I just got done doing this. I double checked myself, and it sure seems like when you buy Prosus, you're buying Prosus's net asset value, which I think 80% of their net asset value is Tencent. You're buying that $1 of net asset value. And again, the $1, 80 cents of that is Tencent, but you're buying the full $1 for 60 cents. And I didn't even go into Naspers yet. I think the discount is even bigger, but I haven't really gone there yet. But Tom, I mean, what are your impressions of that? You're buying $1. 80 cents of that $1 is Tencent. Tencent might be undervalued right now. You're buying that full $1 for 60 cents. You're getting the management that was smart enough to buy and hold Tencent and the chair and the board and all that kind of stuff. That's who you're getting to allocate your capital. And you're buying $1 for 60 cents. We all hear about cigar butts, and we all hear about cigar butts selling for half $1 or whatever. We're talking 60 cents. Wonderful business. I mean, and there's not a debt problem at Prosus. Like, they have $3 billion of net debt, and you compare that to their assets of like over $200 billion. Their net assets, like, I mean, is it just me, or like, is anybody else excited about this? Like, it seemed pretty exciting to me. What do you think?
Mm-hmm. Yeah, it's interesting. I know Frank likes it a lot. He's said he kind of likes it more than Alibaba. When I first started looking at some of these Chinese businesses, I almost took the basket bet approach. So rather than just focusing on Alibaba, maybe, it's all kind of beaten up and I can't quite get my head around any one of them specifically. So maybe I just, pick 4 or 5 of them, like Pinduoduo and Tencent and JD.com and Alibaba, and just make a basket bet. But I've sort of gone over time to just focusing more towards Alibaba. I think the more I spend time on that, the more I can maybe get my head around that particular situation. So to be honest, I haven't spent a lot of time looking at Tencent other than when things like WeChat Pay have come up in like Alibaba research. So for me, that would be the first thing I'd need to get my head around. But anytime you can buy great assets at a discount, that's of interest. So yeah, I think it's an interesting situation.
I think it's been one of those where it smacks people in the face so hard, and it's so right there in front of people that for whatever reason it just seems like, oh, there's something I'm missing, or it should, or how could it possibly be this good? I just cannot remember the last time you could buy a wonderful business or like even a really good business for like 60 cents on the dollar, or a little bit less than that if that's 80 cents of their dollar. But like, you get my point. Like, it just, I don't know. And then you think about like risk and debt and all that kind of stuff, and you don't really have to worry about that in this situation. So the only ways I could figure out like why is there such a discount? I know holding companies in general have discounts. Okay, maybe that's good for 5 or 10%. I know people say, well, you have to pay management to hold your asset. Okay, but this management in particular, I would pay to manage my assets because they're good managers. And the other thing is like, if there was debt, I could see how maybe for like if there was a bunch of debt, that would scare people off and put a big discount. I'm not really seeing that either within Tencent itself or with Prosus. And then the only thing I can think of besides either just the market is just missing it, and it's not really my problem to figure out why they're missing it. But if I try to figure out why, to some extent, quite possibly it could be the complexity of what's going on with their share count and the swap, or however you define it, with Naspers and all that. Maybe. But I sure liked what I was seeing when I dug in today. Of course, I got to do a lot more work on Tencent. I think as I get more familiar with Tencent and read some write-ups about it and kind of look at the way they present themselves as a company and learn about what they have inside of Tencent, I think my confidence in allocation might grow. But where I'm at now is 7% bet through half Naspers, half Prosus. Feel really good about it, both in terms of the potential upside of what could come out of Tencent and even what they could do themselves at Prosus with their other stuff. And then on downside, I feel good about it because, I mean, I'm buying a dollar for 60 cents, and that dollar might actually be worth more than a dollar right now. And there's no threat of like not being able to service the debt or anything like that. And so it kind of helps me sit back and breathe easy. And in terms of where we go from here, if I get more familiar with Tencent and the price stays low, I might up my allocation 10, 12%, maybe a little more. But other than that, the tin can, Tom, it's going in the tin can on my desk, and I'm putting the Post-it note in there that says 10 cent Prosus Naspers, and I'm not selling it unless the business stops getting better or if it's egregiously overvalued. I'm looking at that as basically permanent capital, and I won't part with it. And take some money off the table out of my portfolio and stuff, because then I've got less money to go buy cheap stuff with. But at the same time, I think that discipline to hold, I mean, look what it did for the Naspers management over the last 2 decades. Like, there's a lot to say about holding wonderful businesses, especially if you buy them at a pretty good price. So that's my take on Prosus. Tom, what I try to do, because sometimes I don't think my intelligence in some areas is so high. In other areas, I think it's very high, but in some areas it's not. I try to make things simple. So I hope I'm right about the whole situation, but did I at least make it a little simpler for you and kind of catch you up to speed on at least where some people are looking at it, the way I'm looking at it?
Mm-hmm. Yeah, I wrote down a few questions sort of while you're talking there, and then you proceeded to answer some of them. But I guess the some of the initial questions that would come up in a situation like this, I guess, you spoke about the management costs. I know Bill Ackman's fund, Pershing Square, I think trades at a little discount to net asset value because you're paying Bill Ackman to kind of run the money. So that was a question
Right.
I had, but it sounds like you're kind of comfortable to even pay up maybe for the management. So that's kind of interesting perspective. The other thing the other, I guess, big one probably on a lot of people's minds with this type of situation is, you know, do you know sort of how this discount has looked over time? Like, has it got wider or narrower? Do you think it'll ever close? And I mean, does it even need to close for this to work out well? So if Tencent does continue to kind of do well?
I don't know how big the discount has been over time. I feel pretty confident in saying that there has seemed to be a discount for a long time with Naspers, and that's part of the reason they did the whole thing with Prosus. So I definitely think there always has been a discount in terms, but at the same time, here's the thing: I looked at the stock ticker of Naspers today, and yeah, maybe it's had a discount, but guess what? It's done for the last 2 decades. Like it's gone up and up. And so there's part of that where like I'm not really looking at it as I've got to buy this to close the discount, because I feel like people talk that way more where they're buying like closed-end funds or other stuff where you have like a 5 or 10% discount and you're like, oh, this is a quick low risk way, quote unquote, to make 5 or 10% in a couple months and juice up returns. I'm not looking at it like that. I'm looking at it like 40% to me is absolutely ridiculous. I don't get that at all. I would expect over time that that's going to close in the sense of like, that just doesn't make sense to me. Like, I don't get how it could be that low. And then in terms of closing the discount beyond just Mr. Market kind of getting there on value, I think that was the whole point of moving the assets over to Prosus and being on that exchange and having that investor pool. I think when you think South Africa versus Amsterdam, I think there's just going to be a whole lot more global capital that's going to be attracted to buying something in Amsterdam and Europe. And then they did sell some of their stake in Tencent from 31% holdings of Tencent to 29%. And with that, I think they're running their own investments. But at the same time, I know they're also buying back like $5 billion of shares between August 21 and August 22. That's like significant right there. And I think I read that they said and I just love this. They, especially if they follow through with it, they said something to the effect of, I'm pretty sure they said this: we're not going to sell any more Tencent for at least 3 years. And I kind of think that mindset is beautiful. It's like, yeah, we're going to sell some from time to time to buy back shares or help the market understand that we are trying to close this discount here. But at the same time, we don't want to be out there selling Tencent where it might be undervalued and just not giving the market guidance on like how much we're going to hold, how much we're going to sell. So sit back, let's see where we're at in 3 years from now. And that's so long in the day-to-day cycle of investing where everyone's focused on the short term. And so I have confidence that it would close over the long run. Will it ever get to a 1-for-1? Probably not, because someone could just go buy Tencent. But will they do very smart things with that capital? My sense now is I don't have any reason to doubt that based on what I've seen them do to date. And then with stuff like the share buybacks and the discipline to not sell for another 3 years, I kind of like it. And then it's kind of cool to get at. You hear about these payment companies, you hear about these food delivery companies, you hear about Brazil and India and all that kind of stuff. It's nice to get a little bit of exposure there, especially when you're basically getting it for free. So that's how I'm kind of looking at the discount. I think it's ridiculous, but am I making it on purely it's going to close that discount fully? No, it's not really that kind of investment. But I would be shocked if it's selling for a 40% discount, if that's what it is today, a few years from now. It just doesn't make sense to me. Seems like there's way too much value to easily capture there.
Yeah, no, that's really interesting. I think you've convinced me to take a closer look at this. I do have some concerns about sort of over allocating to China, just because I'm not in China, I'm not on the ground, kind of seeing what's going on. So maybe it's one that I take a look at, and if it stays cheap and kind of cash builds up, maybe I start allocating there instead of adding to an Alibaba or some other position. But warrants a closer look, I think.
I mean, that's where I'm at. And the more I dug into it, and especially like for real, if that share count is 1.45 billion and it really is that lower number, then and you do get that 40% discount to net asset value. I'm also continuing to look, and I would be I would be very motivated to get that allocation up to 10 or a little more percent than the 7% where it is now. Mm-hmm. But you combine that with 10, 12% of Alibaba, now you're kind of pushing my limits on how much I would allocate to China, I think. Because now we're talking maybe 20, a little more than 20%. So I'm kind of at that limit too.
Yeah, that's fair. Look, I want to change topic a little bit. There's one other position I think if we've got time we might loop back around to, but we'll see how we go. But I want to change tack a little bit to cloning. I think I mentioned earlier that, I don't know, you might have to let me know where you think you sit in the cloning rankings, but I'm thinking you're number 2, maybe going up against Brad in terms of the world's best shameless cloners, with Monish being in first place. What do you think about those rankings?
Sorry, the video broke out there just for a second. You're saying Monish is the ultimate cloner, and then me and Brad are competing for number 2?
Yeah, I think so.
I don't think so. I don't think it's a competition.
What, Brad's in second?
No, Brad's in third. And I'm first. I'm right behind Monish, and because I think we're both in Racist now. We both made a clone there, and I think you can ask Brad, and he'll be open with you. How did Brad get into Racist? Who pushed him into Racist? Who motivated him to be that much of an intense and ferocious cloner? I think in Richer, Wiser, Happier, they one of the points that Guy Spear, I think, wanted to get across about Monish was that it's not just fun and games with cloning. It's not shameless. It's not just shameless. Yes, it is shameless cloning, but we all kind of smile when we say shameless cloning, and it sounds like fun and games and stuff. It's not that. It's shameless, but it's also, I think the adjectives he used were intense and ferocious. And I think both Brad and I had the shameless. Both Brad and I had the intense. But I think I brought the ferociousness out when I figured out how to get our hands on Racist. And I went on Punch Card. I don't think you were on that night, but I was on with Brad and Jack. And I challenged Brad. I said, neither of us own it. We both want to. Where there's a will, there's a way, just like Monish said about compounding 50% a year, Warren Buffett, 1950s. How do you do it? If there's a will, there's a way. And I brought that ferociousness, and because of that, currently things could change over time, but I would say I'm the top shameless cloner in the world, and ferocious and intense, right behind Monish. I'll never be more than Monish, but I would say I'm number 1 in the rankings behind him. Brad's number 2. There's nothing wrong with number 2, but I'd say number 1 for those reasons. Did I make my case fairly? Like, isn't that a good case to make?
Yeah, I like that. Well, we might see a fired up Brad in the comment section of this podcast, but if he wants to come on and defend himself, Brad, you're welcome. All right, I've got 2 main things I want to ask you about cloning. I want to ask you, firstly, I guess, why is cloning such a powerful mental model, and kind of how do you use it? And secondly, we'll maybe touch on this later, but I want to get into some more specifics about actually some of the rules you've implemented around cloning. I know, for example, in adding investments to your portfolio, you've got certain thresholds around price, and there's certain people that you choose to clone and other people you don't choose to clone, and so on. So we'll maybe touch on that a little later. But first, tell us, why clone in the first place? Why is it such a important thing that you've implemented?
All right, so Tom, not to toot my own horn too much here, I just said I'm not that intelligent in some things, like possibly verbal communication. So I appreciate you having me on your show and subjecting your audience to this. It's also ironic that I have multiple podcasts, and I don't think I'm the best speaker. I try hard. So I am humble, but honestly, like in some areas, I think I'm a genius, and I think I'm a genius in spots. And one of those spots is just being rational and knowing when there's a good idea. And like shameless, ferocious, and intense cloning, you wouldn't think you have to be a genius to see how powerful it is, but I guess you do, because like not a lot of people do it. And It's the same thing like with the, why are we talking today? Why are we friends? How do we get to meet each other? It's because when we heard about value investing, when we saw Monish, when we saw Buffett, when we saw Munger, something clicked inside of us. And as soon as it clicked, we were in, and we were in forever. And to me, it's been the same with cloning. Like, as soon as I heard Monish talk about cloning, the way he described it, the examples he used, something just clicked with me. And ever since then, I've just been, I don't know, I just can't go back to the other way. So if you ask me, why do I do it? Why do I think it's such a good idea? I just think it's it's unimpeachable as a good idea, as a great idea, both in investing in all aspects in life. It's like, obviously such a genius thing to do, but why do I think that? I guess the only thing I can add to it is I feel like I have the ability, because in certain areas I'm smart, I have the ability to see it, I guess. And once you see it, if you can see it the way I see it, there's no looking back. So that's why I'm so big into cloning. Mm-hmm. I can see it is the answer.
I like it. And give us some examples of how you've implemented cloning. I've heard you talk about the investing side of it quite a bit, but do you want to talk about maybe how you've implemented it in your business? I know you run a business, and other aspects of your life where cloning's been powerful.
So I'll tell you some business stuff, and then I'll tell you some personal life stuff and some health stuff. But I think in business, it's in the way I've gone about marketing myself for just day-to-day business stuff. I've cloned some great people. It's a little bit difficult for me to bring up stuff there because there is some like just stuff I don't want to talk about. But the other reason it's difficult is because like everything I do in my day-to-day business, like talking with clients, running my business, marketing, everything I do is cloned. And a lot of the times I don't remember where I got it, but like everything I do is cloned. So I just always try to clone. In terms of personal life, I'll give you a couple examples. Number one, there's a great comedian and podcaster, Adam Carolla. Have you heard of him, Tom, down in New Zealand?
I've heard you talk about him. That's about the extent of it.
Okay. He's just a great podcaster, a great mind, and a very smart guy. And one thing he used to say it a lot more, but one thing he kind of mental model he had is if something doesn't make you happy, or if it doesn't make you money, stop doing it. And so I've cloned that in my life, and it's something I'm always trying to remember. Like, okay, if something doesn't make me happy, am I making money from it? Okay, maybe I need to keep doing it. But if I'm not making money from it and it doesn't make me happy, like just stop it. And so I've cloned that in personal life. And then in even more kind of personal, almost embarrassing clone, I'll tell you about. There's a new song. Have you heard of Ed Sheeran down in New Zealand?
I have definitely heard of Ed Sheeran. You can't see it, but there's a guitar sitting over behind me there, and I've been playing some Ed Sheeran recently, so I definitely know.
So he is in your wheelhouse. You like his music?
Oh yeah,
that's okay. Me too, a lot. And he's got a new song called "Bad Habits," and I don't know with certainty what that song is about, but it sure sounds like it made me think of like drug use, like or alcohol or whatever. You stay up past 2 a.m. Nothing good happens past 2. Got nothing left to lose, to use. And every night I go into the night telling myself I'm not going to do it again. And then I do it again. I don't even believe myself. When I say it, okay, where are we going with cloning? Let's stay on track here. I'll tell you what I've cloned. I've cloned the 12-step mentality. I've cloned the Alcoholics Anonymous mentality when it comes to going to bed on time and waking up on time. And as silly as that sounds, I'm in a bit of a predicament here, Tom. My natural wiring, I think his name's Matthew Walker. He just came out with a great book a couple years ago called like Why We Sleep, I think is the name of it. And there is like like a lot of people say, if you sleep in, you're lazy and all that kind of stuff. And there's that stereotype about people who stay up late and sleep in. That sure, it's true for some people, but that is 1,000% like not true for a lot of people, because there really is something with like the wiring and the DNA. The majority of people are morning larks, or whatever you call it. Like they're morning people, and their wiring is to go to bed at 10 to 11 or 9 to 11 and wake up at 6 to 8 in the morning. Like that's their wiring. And that's why the majority of the world runs on that schedule: school, work, everything. But there's a smaller percent of people that their wiring is to go to bed at 2 or 3 in the morning and sleep till 10 to 12, 10 a.m. to 12 in the afternoon. That's my wiring. And it's a smaller percent of people, and they think it's because humans used to live in packs and we would move around a lot, and it would just be beneficial if you could limit the amount of hours that everyone in the pack or the camp was sleeping, because you'd be more vulnerable when everyone's sleeping. So if you can limit it, some people would stay up late. Most people would get up early. Some people would get up super early. There'd only be a small amount of time everyone's asleep. So I've got that wiring. The problem is with children, with business, that's not the way the world works. With dogs, it's just not the way the world works for me right now. And so like it impacts my health if I don't take care of myself in that regard. And getting to cloning, one of the things that has worked for me is, I don't know why, I've never had a problem with this. I don't do this stuff ever. I don't even drink really, like at all. I might have 2 glasses of wine a year, if that. I'm just not attracted to it. But for whatever reason, through watching The Sopranos, through watching a bunch of comedians talk all the time, I'm like very familiar with the 12-step and that Alcoholics Anonymous, those kind of programs. And it also seems like that's like maybe possibly the only thing that actually works really good. And I might be speaking out of school here, but what I get from those people is that like once you're an addict, you're always an addict, and you're never going to get better. You're always going to struggle with that struggle. And you just have to have the mindset of like, every single day I'm going to have to try to fight this thing and just beat it for one day. And so when Ed Sheeran comes out with this song, Bad Habits, it's making me think about drug use, alcoholics and all that, and alcohol use, and how those people who do it, who fight it with the Alcoholics Anonymous way and the 12-step program and all that, where they just go to meetings, work the program, all that kind of stuff. What I've cloned the mindset that me going to bed on time, doing something that's against my natural instincts, because they are natural instincts and DNA wiring. Well, I have to do this at this point in my life, go to bed a certain time, wake up. And I know how silly that sounds, but people who have this night owl thing, they would get it, how hard it is. I've cloned their mindset. I've cloned their language, in the sense, like I tell myself, like if someone asks me, how's my sleep going? I tell them one day at a time. I tell them I'm working the program. I just look at every day as a fight. And the most important thing, the only thing I have to focus on, is getting to bed at the right time, winding down, all that kind of stuff, and think about it all day long, remind myself about it all day long, be in the fight all day long. And just how for like a sober person, all they have to do is stay sober, and then the rest of life will be easy and take care of itself. All I have to do is figure out my bedtime schedule, go to bed, focus on that all during the day. And then business, investing, I'm so good at that other stuff, I'll just thrive, but I'll just really ruin my life if I don't work at that, fall into sleeping too late, and then I still have to get up early. So then I don't have enough sleep, and then my life's ruined. So you asked me cloning and how ferocious I am and all that kind of stuff. That's one example where I've done it from outside of investing. And it really has been, so far, the only thing ever that's worked for trying to get this sleep habit thing under control. And so that's an example of just personal life cloning.
Yeah, that's I really like that. There's other things that I've kind of cloned as well on sort of the YouTube side. I guess kind of like you've picked up things with the sleep, and maybe on the business side as well. Is cloning something that has always, is it an idea that was like the inoculation of, that people talk about with value investing, that kind of just hit you over the head and you were, made sense, let's do this kind of as aggressively as possible? Or did it take some time and reading The Rich, Wiser, Happier and Guy Spear to kind of do it as intensely as you're doing it now?
It's a mix. It hit me over the head. I saw the light as soon as I heard about it, but it's not something that comes natural. And it's probably, there could be some evolutionary thing, but it's also every day of your life as a student, they beat it into you. Don't plagiarize, don't copy, don't even get near that line. So they beat it into you in school. And then in life, there's this thing about, copying is bad. It's illegal in business, a lot of business with like copyrights and patents and all that. So just culturally and just every day of my life, I'm getting input that says don't clone. And then I hear, when I get reminded to clone, then it becomes so, I see the light again and it becomes so clear that that's what I should be doing. So I have a post-it note on my computer here, clone always. I'm always trying to remind myself to clone. The whole quarterly 13F thing, it gets us in a good habit that at least 4 times a year, I'll remember to think about cloning and be in that mindset. And just speaking about how a lot of people don't like to clone or talk about it that way. There was a funny point in Richer, Wiser, Happier where he's talking about some investor using cloning, and the investor would tell him, yeah, like one of my strategies is I do look to the greats and clone it. But then William Green said the guy didn't want to refer to it as cloning because that makes it sound a lot like cheaper or not an attractive way to say it. So there's still a lot of people that don't want to go there. And so, yeah, it's something that hit me over the head. I saw the light, but man, I have to work at that thing all the time to remind myself to clone, because if I'm not constantly reminding myself to clone, it's very easy to forget to not only clone in investing, but then it's easier to forget it outside of investing, because in investing, Monish and shameless cloning and 13Fs, we usually remember to do it. And it's like one of basically my main investing strategy, or it's the way I get started with a lot of investments. But even outside of investing, it's so much easier to forget because you're not kind of getting that 13F kind of strategic reminder. You're just getting a bunch of negative input about cloning. So yeah, see the light. It's very clear, but I always have to remind myself. And I do find myself all the time forgetting to clone.
Mm-hmm. Yeah, I like that. Yeah, it's exactly the same here in New Zealand. Like in the school system, you're getting, don't plagiarize and so on, kind of pushed down your throat for your entire kind of education. So it does feel a little bit unnatural, I suppose, at least initially, to try and be a cloner. But you don't get extra points for original ideas in investing. So why wouldn't you be a cloner, right?
Well, you're allowed to clone, and it's easy to clone for whatever reasons. The regulatory system has just made it easy. A lot of great investors like talking about their investments, which helps. And then you can clone ideas, not just investments. And I was thinking of some interesting thing. I think I've lost the thought about. I think I've lost the thought, but I had some thought about cloning. If I remember, I'll let you know. I lost the thought though.
Yeah,
floated away.
Well, the one thing I did want to pick your brain on with cloning on investing specifically, I mean, I've had this idea for the last maybe month or so of starting like a new series on my YouTube channel. So I want to start basically like a shameless cloner portfolio and come up with some rules around how to pick different stocks to build this portfolio and just kind of track it and sort of see how it performs. So I'm excited to get you on here and pick your brain about some of the rules that you've implemented. Do you want to talk us through how you think about applying, how do you go from seeing a stock show up in a 13F? I mean, how do you pick the investors that you clone in the first place? And then how do you think about selecting the actual stocks that end up in the portfolio eventually?
Okay, so in terms of which investors, I just clarified this thinking for myself reading Richer, Wiser, Happier, because I forget exactly what cued this thought, but at the beginning of the book, it was probably that Monish chapter where they're talking about cloning, and they said something to the effect of find investors that you relate to or that you kind of get. And so what that clarified for me is that I've got this thing where like I have people that I clone almost religiously, or like if I see them buy something, I'll be very, as I've heard you say often, and now I'm starting to say it, I'd be very keen to invest with the way they invest. And then I've got these other investors, which are like super investors. I really like them, but like I don't click with them as much as I click with these other guys. And I find myself not cloning them as religiously. And so what this clarified for me is I've got my Mount Rushmore of investors, my Mount Rushmore of cloners. And that would be Warren Buffett, Charlie Munger, Monish Pabrai, and Guy Spear. These are the 4 investors that I find myself to have the most in common with. I find myself, when they talk about the way they think, I'm like, oh, I think that way too. Temperamentally, I find myself in line with them. And so those would be the 4 that I'm most keen to clone. There's another set of investors like David Abrams, Cliff Sosin, and some others that I follow them every quarter. I do invest the way they invest, and I do look to find clone ideas from them. But it's a little bit, I find myself just doing it less often. So I guess the first thing I'd say is find your super investors that you would just clone overall. But here's the thing, we've seen this with Brad and all the investors he's been talking about lately. I think one of his goals he's been working on lately is to find more and more people to clone and find more super investors to just track and be aware of. And the interesting thing is, like, there's a lot of them out there, and you might find yourself getting to the point of like 10 or 15, maybe more super investors. And you look at what some people do quarterly, that's like a lot of investments to follow and all that kind of stuff. So first point of advice, or at least describing the way I do it, get your kind of universe of people you would clone, track them, and have a system for tracking them each quarter. But also within that universe, find the handful of investors that you're most in line with, just temperamentally, and you think you kind of understand the most. And maybe they make them kind of like your top tier of super investors that you look at when it comes to cloning. I want to throw out there, I also look at insiders as clone for cloning ideas, insiders of companies, management, board members, and then to some extent 10% holders. I track those kind of investors all the time, and I'm aware that when I have a way to track insiders, and I work at that, and I also look at that as a form of cloning. So I want to throw that out there. But that's who I look at to clone, and then if you want to get into rules beyond that, I always assume the quarter they bought it in, they bought it for the low during that quarter. I always assume that they bought it on the low for the quarter. And that just makes it easy. And I would say 99% of the time, they probably didn't buy it for the exact low, but that's working from a conservative point of view. And it helps just give me a hard, fast rule so I don't have to think about it. And then my threshold is 30%. If I can buy a stock for within 30% of when it was selling during that quarter that they bought it at the low, 30% within the low, it's something I'll look at. And everything is gray. If Charlie Munger bought Alibaba and I had never seen this before and I get excited about it and now it's selling for 31% of that price, maybe I'll be open to it. But I kind of use that 30% as my threshold rule. And then do I buy everything they buy? No. Do I sell every time they sell? Sometimes. I'm a lot more keen to sell when they sell because especially if I'm cloning, that's the whole point of it. So if they sell completely, that's like a really big red flag for me. Like, hey, maybe it's time to sell. If they sell a little bit to buy something else, maybe I'm not as fast to sell. And then in terms of allocations, I think this kind of wraps up everything, all my thoughts on cloning. In terms of allocation, obviously, I look at their allocations. If it's 3% of their portfolio, I don't assume that I'm going to go in for like 20 or 30%, obviously. I always keep in mind that a lot of these investors have foreign holdings that don't show up on the 13F. Like I think even Charlie Munger, I think he still owns BYD, the battery company. And I think a lot of people think he's like 20% into Alibaba when really it might be closer to 10% maybe. I think, but I'm always reminding myself they have outside holdings. Sometimes they have private holdings that make the allocation even smaller. But I do factor in kind of where they're thinking on allocation. And then the more firm I can get with an understanding of a business myself, the more I can get a business within my circle of competence, then I have more confidence to grow my allocation just for myself and kind of separate it from what they did with their allocation. So those are my grand thoughts on cloning. And I can tell you, it's a great place to have at the center of your investing universe. And yeah, I can take shots in other places with some of my portfolio. And yeah, sometimes those work out really good. But I just love having that cloning as the bedrock of my investment kind of activity, because I'm investing the greats, I'm cloning the greats. So that's what's worked for me. So sorry to go on there, but I want to give you the overview of kind of what I do with cloning.
Yeah, no, that's really useful. You know what I'm going to do? I'm gonna try and take Brad on for third place, and I'm going to clone exactly what you've just told me for the series on the channel. So that's fantastic.
The fact, and we can just keep pushing them down lower and lower. The fact that you are actually open to hearing an idea, and if you think it's a good idea, which maybe you do, and actually cloning those rules or whatever to make it easy, I think you're now officially in second place. So we need to see a transfer of the silver medal. We're all up on the podium there, and we're going to make the second place guy take off his medal and give it to the third place guy, because you've now been bumped up. But Tom, I mean, honestly, doesn't that really just make sense? Like, you get hit with so much information. Doesn't it make sense just to maybe keep your list of cloners? Like, yeah, track all these people that you like, but maybe look at a certain few differently. Doesn't that make sense? And then doesn't it also make sense to assume they bought it for the low and have that 30% threshold? Because you're conservative, and I like the fact that there's rules. Do those click with you? Those ways that you don't have to think anymore, you just have these rules in place. Does that click with you?
Yeah, it does. I mean, I put together like a full list of all the people that the 13Fs I pay attention to a couple of weeks ago, and I think there was like 16 people on there or something, and that's just too many, I think, to actually clone, unless you want to have 30 positions or something, which is just doesn't click with me. So I think it's having the Mount Rushmore kind of investors that you sort of think you're most closely aligned with. That makes a lot of sense to me. I mean, this is kind of minor, but I'd probably be less conservative on price and pick like maybe the midpoint of the quarter or something like that. But that's a minor tweak. Overall,
that's fair.
That's a great framework.
Isn't it interesting once you start following, like, say, 16 super investors, that so many people talk the talk of like, I don't do anything all year long. I'm looking for one or two ideas. If I'm lucky, I'll buy one or two new stocks in a year. And then when you see these 13Fs roll in, a lot of activity. Have you noticed that?
I have noticed that, and I've been guilty of that myself. I mean, I pulled it up a couple of months ago to see how many transactions I've had this year, and it was like a surprisingly high number. I think Alibaba is the only brand new stock in there, but there's been more transactions than I'd thought there may be, kind of around the edges with trimming stuff to free up cash to buy things and that sort of stuff.
Okay, I got two things for you. One is to wrap up cloning. Don't forget to look back a few quarters or even a few years. One thing I've noticed, especially with the Berkshire Hathaway guys, and by the way, Ted and Todd, those guys are kind of in near my Mount Rushmore too, because I feel like I click with them, and if Buffett clicks with them, I click with them. So don't forget to look back a few quarters every time you're doing your quarterly 13F reviews, because a lot of times what happens is these super investors will buy like a business a year ago, or they'll buy a business 2 quarters ago, and then they won't have bought it for a while. But then every now and then you look at the price of that business and you're like, oh man, that thing is within my 30% threshold, and I could buy it for prices they bought it at. And for whatever reason, they stopped buying because maybe it got too big of a percentage allocation. They didn't want to go past that, but they haven't gotten bearish on it. They've held it, and the thesis still holds for the reason they first bought it. And so you can get some good ideas looking back a few quarters. And then I wanted to premiere a new idea to you about investing. I'm going to talk about this on my podcast this week, actually, but I wanted to premiere it on your show.
Wait, and so this is an original idea? This isn't a clone? This is an original idea of Jason? Is that what we're about to? That's what we're about to get?
This original idea, yeah. Okay, and we'll see what you think of it. But we've talked about him. What's up, stock compounders? Brad here. We've talked about him, and let's talk about him again. One of the things about Brad, and I look up to him, and he's got tons of great content, and I'm learning a lot from him. One of the things, and I've asked him this on his Q&As, every day I turn on my phone and look at YouTube and Q&A right now. So I've asked him this question, and I asked him, like, Brad, you seem so dialed in on the only a few bets and big bets and high conviction and hold forever. And people ask him, like, what's the price of Alibaba, or Alibaba's down? What do you think? And he's like, oh, it's down 25%. I haven't even noticed. And he says it with such conviction that you're like, this guy might actually do this stuff. Like, he just seems to have that value investor mindset that just is perfect. And you're like, wow, like, I talk the same talk, but I do look at the price of my stocks day to day. And like, this guy just seems like he's fully bought into this stuff. So I asked him, like, does this come natural, or do you have to work really hard at this? And I think he said something to the effect of, like, no, he really works at it. And I think part of him, repeating it and kind of saying it with such sincerity, like, no, I haven't looked at stocks and stuff, is to kind of sear it in for himself. And one of the things he seems to do, at least right now, is he goes with the few bets, big bets. And he really is disciplined about not putting a bet in unless he really feels comfortable, because I think his thing, at least right now, is like 20% bets. He wants to have 5 bets. So I've come up with the Brad bar. That's the original thought here, the Brad bar. And the Brad bar is, thou shalt not invest in a business unless you are comfortable with that business being 20% of your portfolio. And it doesn't mean that you have to put in 20%. It just means you have to picture yourself putting in 20% and feel comfortable with that. So I'm going to do a deep dive on a company called Hibbett Sports. It's like a retailer in the United States. Stock's gone up a bunch. Coronavirus ended up being great for them, I think. Like, a lot of people bought their retail stuff. They're selling clothes and shoes and all that. And they've had a run up in their price, and they're buying a bunch of shares, and their sales are going up and all that. They're opening stores. And I looked at it the other day, and I think they might have insider buying as well. And I was like, you know what? I really like this. But then I was like, I don't think I like this for 20% of my portfolio, like, at all. Like, I don't know where it's going. It's not in my circle of competence. One of my super investors hasn't bought it. Yeah, like, me before the Brad bar rule would, like, go, yeah, I'll put in 3%, grow my position, kind of grow into it, maybe learn more about it. But then I thought about the Brad bar, and I was like, you know what? If I don't feel comfortable enough to put in 20%, why would I put in 3%? And how do I become comfortable enough to put in 20%? Well, for me, it's all about knowing where I'm at, exactly where I'm at, feeling firm on firm ground, and kind of knowing exactly what I'm buying, knowing my upside, knowing my downside. And I feel like when I know my upside and I know my downside and I know it firmly, then I'm confident going up to 20%. I rarely do, but I'm confident going to 20%. And so that's the rule. If you don't feel comfortable going to 20%, then you can't go in yet because you haven't done the work, or it's not as safe of an investment, or you don't have the margin of safety you think you have. And so 20% is inspired by Brad, because that's kind of his bet size right now that he's talked about. Do you like my Brad bar rule in terms of getting into new stocks? Do you like that?
I like that a lot, and I think I have some bad news for you, Jason, because I'm not sure that that's an original idea. I think it may be a subconscious clone of that you've just done, and you've labeled it the Brad bar. So this is an idea that I've tried to implement for a long time. It's why I, when we were talking about Naspers and Prosus before, I said I hadn't made kind of a bet on that because I'd been focused on Alibaba, and part of that's because I wouldn't be comfortable, putting 20% in it. That is kind of like a mental test that I go through as well. I think that's an idea I actually got from Phil Town. I don't know if you follow Phil Town a lot, but that's sort of a threshold that he describes exactly the same, actually, the same number, 20%. He says, if I'm not comfortable putting 20,
even if, sorry to cut you off there, but I'm very curious, even if you don't put in 20%, he's literally saying something to the effect of, don't go in at any stake if you wouldn't feel comfortable going in at 20%.
Exactly.
Wow, that's interesting.
Mhm.
Well, I know Brad is very familiar with Phil Town, and so there's probably something subconscious going on there where now that's Brad's bet size at 20%. That's what he wants to do. And then I take this from Brad and then morph it into, well, don't go in unless you're comfortable if you were in for 20%. And it's like looped around to maybe where the original 20% thinking came from. Very interesting.
Yeah.
Well, and
Yeah.
by the way, I'm not offended. I'm not offended that you outed me on one of the biggest investing podcasts and YouTube channels ever. I'm not taken aback, and don't think I'm angry in any way. I am humbled and honored that you called me out as a shameless cloner when I didn't even know I was cloning. I'm very proud of myself for being so in the cloning mindset that I was able to clone without even knowing I was cloning.
Yeah, I think you should be proud. That's actually quite impressive to have cloning so ingrained that you don't even realize you're doing it. That's very good of you. I like it.
Well, again, thank you very much for the compliment, Tom. I mean, have I at least made you feel a little more strongly about cloning, or did you think I had taken it to this level? Like, I hope it was a fruitful part of our conversation for you.
Yeah, look, I had a pretty similar, I don't know if realization's quite the right word, but, that Guy Spear quote about being an aggressive cloner or whatever he exactly said,
Yeah.
That did stick with me as well. And something after the conversation with William Green that stuck with me is and I got a question on this in a Q&A video as well. It was kind of asking, what was my biggest takeaway from Richer, Wiser, Happier? And I don't know that there was really one particular lesson that I locked on to other than William Green saying, if there was one particular lesson that, you really liked in Richer, Wiser, Happier, like just grab onto it and, go kind of full steam ahead with it. Don't just say, that's a nice idea, sounds great, maybe I'll do that half-heartedly on the side. Like, grab that and just go full steam ahead with it. And Moj Pabrai, I think, said something to the same extent in his chapter, that people hear the idea of cloning, or they hear some other mental model that they think is powerful, but they never do anything with it. So I think I was already on the well on the way to being quite convinced about cloning, but you've helped.
Yeah, well, thank you, and happy to share. And I think for me, one of the things I loved about his book, and again, I just finished it up, so it's very fresh on the mind, is that it's almost like a starting point to all the resources he talked about in the book. So, like all the investors he talked about, there were some investors that I had never really heard of before, but they've got lots of we would in today's world call it like content, but they've got lots of stuff they've shared in the public space, just speeches and talks and all that, and maybe articles and letters and interviews. So there's like tons of other investors to start digging into. And then he mentioned some great books on totally different topics in investing to kind of look into. And so that's one of the things I really got out of the book was just, wow, what a starting point to just go dig into a bunch of new investors and new information as well.
Yeah.
Tom, what do you think about this idea? I know at the end of your conversation, you asked him like, what's next for William Green in the investing space, and if he had any other books planned. And one thing I thought, it'd be kind of a tough book to maybe put together, and I don't know if people would necessarily volunteer to be covered, but like there have been great investors who kind of were on the great investor trajectory or even were known as great investors, and then they flamed out and then it all blew up. And again, it's not the best it's not the most cheery topic, but like the lessons of like what the super investors do right. This book obviously covered great, but I'm so curious now to know like, okay, now that we're all on this path, people like you and me, to be great and to follow their footsteps, what are some of the kind of the traps we have to avoid, both in terms of personal life and the way to live, and then also just investing traps that we can avoid? I think that would be awesome as kind of a different look at how to be a great investor, looking at the downside there. So that's one thing I just hope someone would write that book, or maybe myself, I could look at those investors, but that's where I
Yeah.
was kind of going when you guys were talking follow up.
Mm-hmm. Yeah, for sure. I think that'd be really interesting because with the book on 100 baggers, a similar kind of philosophy is explained up front in that book, that there's a lot of survivorship bias in looking at the great investors
So
and in
much
looking at the
survivorship
100
bias
baggers
these
and so
days.
on.
Yeah.
Yeah. So I think that'd be fascinating. It kind of reminds me of Monish Pabrai's exercise of going through and trying to learn from other people's mistakes and seeing what has caused them to have poor investments. And that's where he identified that, leverage is by far and away the biggest culprit in, investments blowing up and so on. So it's almost like an investor specific kind of focus as opposed to like particular investments, but similar sort of idea, I suppose.
Yeah. Yeah. And I'm very, very interested to see what he follows up with because, and no pressure no rush, because I know this book took years and years, but look how it paid off. Just a great book and great interview you did too.
Yeah, no, I appreciate that. It is very, very good. Jason, I know you need to get going, so I better let you go. But really appreciate your time. It's always great to chat with you. These are always very enjoyable conversations. If anyone is interested in sort of following along with what you do or listening to your podcast, and I know you've got a YouTube channel as well now, where can they go to see or hear more from you?
Yeah, so afterdinnerinvestor.com. I do a little bit of writing there, but you on that site you can find all the podcast stuff, and it's called After Dinner Investor. Comes out weekly. And then on YouTube, just search After Dinner Investor, and I'm growing the YouTube channel. And basically what I'm doing, Tom, is I'm just trying to I think Charlie Munger in that book, Richer, Wiser, Happier, he talks about having someone to talk investing with, and you do it with your audience. Brad does it with his audience, all the punch card guys. Having not only you guys, but just the audience on YouTube and the podcast to bounce my ideas off and force me to do the work and try to come up with reasons why I'm doing the things I'm doing with investing very much helps. So what I'm doing is during the week, I'm trying to put out a video each day on just stuff I'm learning with investing, stuff I'm looking at in terms of different companies and learning. And then when the weekend comes around, I kind of look at what I did on YouTube that week, look at what I wrote, and then kind of put it all together and go a little bit deeper on the podcast. So I'm trying to tie the two together, YouTube and then also a podcast. And I'm following in the giant footsteps of one of the greatest investor YouTube channels of all time, Investing with Tom. And so that's what I'm trying to do.
Well, that's flattering. They're not that big of footsteps. If you, I really enjoy your content. I randomly came across you from just searching Monish Pabrai on a podcast app one day, I think, and I've been an avid listener ever since. So you've got me hooked, and I'm sure if you put out content long enough, you'll more than overtake what I've done. So I will leave all of that linked down in the show notes for the podcast if you're listening in audio form, and if you happen to be watching on YouTube, thanks for coming and watching the video version, and that will be all linked down in the description below. So Jason, always good talking to you, and I appreciate you coming on.
Tom, always great to be here. I'm keen to come on anytime, and hope to come back soon. So thanks very much for having me, and great as always to catch up with you.
Thanks very much.
Thanks again for watching another episode of the Investing with Tom podcast. If you did enjoy it, please be sure to hit like on this video and subscribe to the Investing with Tom podcast channel so that you can see future episodes as soon as they go live.